Hey Bowtie Nation, Joseph Hogue with your weekly stock market update, now coming to you on Sundays at noon before the week starts with the stocks to watch and the stock market news you need to see. This week I'm breaking down the biggest stocks in the market, the winners and the losers in my own portfolio, and the biggest tests coming for stocks like SpaceX and Supermicrocomputer, ticker SMCI. I'll also reveal why my biggest investment is dead money right now and why I just bought another $150,000 in what is my highest conviction investment. Getting us started though, SpaceX, ticker SPCX, jumped 19% from its IPO price and continued higher after hours last Friday to value the company at $2.1 trillion. This is where the test really begins though. Can it build on that price over the next few months? Because most new stocks do not. Research by Jay Ritter at University of Florida finds that nearly 60% of IPO stocks are lower than their first day closing price after the first 3 years. Data by Edward Jones here looks more individually at tech stocks over the decade to 2020 and found that 15 of 27 IPOs were down over their first 3 months, while that number expanded to 21 of the 27 down after the 6 months. In fact, some of the stocks with the biggest IPO day price change saw the worst sell-offs, with Twitter up 72% on its first day, only to give back 31% of that over the first 6 months of trading. Now that won't necessarily be the case for SpaceX though, because we will see some very strong demand from hedge funds and ETFs. Since SPCX is going to be immediately included in the NASDAQ 100 and Russell indexes, any ETF or hedge fund that compare their performance against those indexes likely going to want to buy that stock. If they aren't holding the stock in that same proportion as the index, they're going to be effectively betting against it, which might not be something they want to do. Just going off the dates for SpaceX to be included in these major indexes like the Russell and the NASDAQ, that could create upwards of $14 billion in share demand just in the first 15 days of trading. With the eventual inclusion into the S&P 500 index, that could mean ETFs need to buy as much as 43% of the shares available within the next 6 months. Now, SpaceX does have a 60-day lockup schedule for insiders, which means August 11th and leading up to it, you're likely to see some pressure on those shares as investors fear that IPO insiders are going to start dumping their stock. But there should still be some demand and support on that price. Musk's worst nightmare would be what happened to Cerebras Systems, ticker CBRS, which went IPO last month. The AI infrastructure company was 5 times oversubscribed on its shares available, priced the IPO at $150, and shot up 133% to close at $350 on the first day, but has since then lost 38% of its value. Now, SpaceX received requests for 4 times the number of shares available, but the 20% pop on that first day is a little bit more realistic. Along with Musk's cult-like appeal and the ETF buying, it should help support the stock at least until that August date. Campbell Soup, ticker CPB, is up 13% and beating the S&P 500 15% since highlighting it 2 weeks ago, along with an option strategy to supercharge those returns. Now, I recommended picking up shares for safety protection against any market sell-off and call spreads around the earnings report. And with the pop in the shares, longtime Bowtie Nation citizen Dan made a $27,000 profit on his $22 call options, and the call spread I recommended closed out Friday with a 366% return in just 2 weeks. Now, I still like the stock as a way to rebalance your portfolio and protect your money from any potential tech sell-off, but more important here is that you're using options as a tool to those higher returns, hedging your risk, and to create income. To help you get started, I'm extending the relaunch discount on our Ultimate Options course. Over 3 hours of video, I start with the basics, then walk you through all 29 option strategies, when to use each, and how to set it up, including a real-world example with shares of Tesla. The course also comes with a one-of-a-kind strategy finder to help you find the right strategy, and an options calculator to show you exactly what to expect. That relaunch special is a 38% discount, save $150 off. You're going to get all the basics to get you started, the strategy finder to make sure you're using the best strategy, the options calculator to show you exactly how much you can make, walkthroughs on all 29 strategies, and a 14-day money-back guarantee. And that $150 launch discount is only available with the coupon code I'll leave in the description below, so look for that link or just scan the QR code here. Also watching Supermicrocomputer, ticker SMCI here, down 40% since it surged back to $50 a share earlier this month, first on that general sell-off in tech stocks during the first week, and then last week when the company announced it would sell up to $7 billion in shares to fund costs around fulfilling a $39 billion backlog server orders it's gotten just in the past few weeks. For investors though, it might not be as bad as that drop implies. The surge in orders validates the business and that strong demand. Yes, optimally, they'd be able to cover that cost through the cash flow, but demand is so strong for that AI build out theme that we're starting to see more companies raise this kind of emergency funding. Shares of Oracle dropped 11% last week on its announcement to raise $20 billion in equity financing, and Alphabet started us off a few weeks ago, announcing its own $80 billion raise to fund the AI build-out. Now, as I did warn a few weeks ago, I have started cutting or covering my position in SMCI. I sold just over 12,000 shares in two accounts for a profit of $116,000, a price between $37 and $43 per share. I've also covered most of my remaining position by selling call options against it. That's going to protect me from further downside and will net me another $105,000 even if the share price stays right where it is. With the shares back at $30 each though, I think this is back into good value territory and the August 4th earnings report could bring a positive surprise. Revenue is expected up 103% from last year, with next quarter's forecast for a 133% bump in sales. Here, it would be very hard to justify that dilution from the share sale if sales weren't booming and on track to beat those estimates. Again, though, as I did explain a few weeks ago, I am closing up and covering my shares because I'm just tired of the roller coaster, but there are still returns left to be squeezed out for investors that can stomach the ups and downs in the stock. And here, looking at my biggest investment, while my entire portfolio is up 116% over the last 3 years, more than double the return on the Dow and beating the S&P 500 by 50%, my biggest investment right now is actually down more than $122,000. That's a loss of about 10% on an investment just shy of $1.2 million. And when I say it's in Ethereum, before you click out or head to the comments to flame cryptocurrency as rat poison squared, give me 4 minutes to explain why this is my highest conviction investment and why I just added another $150,000 to it this month. I started buying Ethereum last June directly on Coinbase as well as through 2 ETFs for one very important reason, which I'll detail next. The price immediately surged 113% to a new all-time high, but has since crumbled to its multi-year lows. And here, it's been that deafening, sucking sound that has been all the investment dollars rushing out of Ethereum and other cryptocurrencies to chase those AI stocks. And I get it. Why invest in crypto when stocks like Alphabet and Nvidia are doubling every year? But the reason why I'm buying, that longer-term, big-picture change is still very much intact and will more than double my money in the next 2 years or less. Nation, that's because we are developing into an era of tokenization in finance. This is where you put an asset, an investment, or ownership of anything with value on the blockchain for that digital record keeping of that ownership. Already, more than $30 billion in assets has been tokenized, and this is just the beginning, with BlackRock CEO Larry Fink saying every stock, every bond, every asset can be tokenized, and it will revolutionize investing. To put that quote into context, consider that $30 billion in tokenized assets is just 0.01% of the global equity and bond markets. Compare that to the $270 trillion fixed income and equity markets, or the $288 trillion real estate market, where tokenization would be particularly useful. It's growing at 200% a year, but this is still just a fraction of how big this is going to become, with hundreds of trillions of dollars in assets tokenized and traded on the blockchain. And this isn't just an idea either. JP Morgan is already tokenizing the $30 trillion market for treasury bonds. The NASDAQ exchange is tokenizing stocks listed on its platform, part of that $127 trillion stock market. JP Morgan is also tokenizing the $4 trillion money market, and the largest U.S. banks, including Bank of America, JP Morgan, Citigroup, and Wells Fargo, are all launching a tokenized deposit network in the first half of next year, putting your savings deposits on-chain. And why is the financial system running to put trillions of dollars on the blockchain? Because the benefits of tokenization are proven and undeniable. In traditional markets, when you buy or sell a stock, that purchase or the sell isn't actually as immediate as it appears. Besides only being able to make that trade during certain market hours, there's at least a day settlement delay. You've also got more middlemen, brokers, market makers, the platforms, all of them taking a fee. And all of this is if you can afford that $300 a share of Apple in the first place. But then tokenization fixes all of these problems. For example, taking a $1 million apartment complex and digitizing it on the blockchain means fractions of an ownership can be bought for as little as $5 or $10 each. It saves thousands of dollars in title insurance because of the increased transparency. Your share can be bought or sold instantly, and it can be done 24/7. And these benefits extend into every asset class. into hundreds of trillions of dollars into assets. And here's where we get to the important part. How does that affect the price of Ethereum, and why is it going to send that price to a new record? Because here, the Ethereum network is the standard for where those tokenized assets trade. Think of it like the roads on which tokenized assets travel back and forth. Ethereum sees more than half of those $30 billion tokenized assets using its network, paying fees every time an asset is traded. Yes, some of these other networks like Solana will benefit from that new era of tokenization, but it's only Ethereum that we know is going to benefit because of its dominance. And while an exodus of investor money out of Ethereum and other cryptos for those higher returns in AI stocks, along with disappointment over the regulatory roadmap, has brought the price down from last year's peak, you only need to look at on-chain metrics to know this revolution in finance is still happening. The website The Block tracks metrics for blockchain networks like Ethereum. Here we can follow the growth in transactions, see that those daily transactions have doubled since last year. More importantly, the cumulative smart contracts deployed have exploded higher. Anytime an asset is tokenized or a stablecoin is created, it's made through a smart contract that establishes the rules on that network. The number of smart contracts on Ethereum have jumped 29% from last year to 89 million and have doubled over the last 5 years. That is real use cases of tokenization, and it is just getting started. Now, will Ethereum continue to underperform those hot AI stocks? It's possible, and I know it's tempting just to ride that AI trade higher, but I can't tell you where Nvidia, SpaceX, or even those cybersecurity stocks that we are buying are going to be next year. They're all good companies with strong tailwinds from that AI boom behind them, but I've seen this story before back in 2000 with the internet bubble. Eventually, we will see a burst, and those AI stocks everyone is buying, it's going to bust along with it. With Ethereum, though, I know I am investing in what's going to be the future of finance with a price that is a fraction of what it could be. Asset tokenization and that transactions volume don't equal price directly, but even if that market for tokenization grows to just $3 trillion from the $30 billion today, that's an increase of 100 times over. That's going to take Ethereum back to its all-time high of $4,900 and probably well beyond to maybe $10,000 or more. That alone would be a 6 times return on your money. And the best part is, because that volatility in the price is so high, you can also create some amazing income here while you wait. I sold call options against about half of my position here in both the Grayscale ETH, that mini Ethereum trust, and the iShares Ethereum trust, ticker ETHA. And that's not only created tens of thousands of dollars in income collecting those premiums, but has protected me from over $120,000 of the sell-off in my position. Now understand that selling call options like this does limit the upside return potential, which is why I've only done it on about half of my shares and only over a short time periods, but this is a must-know strategy to use. Now updating our stock market outlook, Wednesday is Chair Warsh's first meeting as the chairman of the Federal Reserve, and there's likely to be more fighting than the White House's UFC match on Sunday. Last week's Consumer Price Index, that CPI report of inflation, showed prices rose 4.2% from last year, with producer prices reported the next day showing prices were up 6.5% over the period. Now, we didn't even need those reports to take hopes of any rate cut off the table, and it could be one step closer to the Fed actually raising interest rates. The UK became the first major central bank to raise rates last week, and the CME Fed Watch tool, that's a market expectations of Fed rate decisions based on the futures pricing, shows the market now expects the Fed to raise rates by January of next year. While the Fed definitely won't raise rates this Wednesday, we will hear more aggressive language around it. 3 Fed members called out the need to drop text around rate cuts in April's meeting, and we're going to see more of that in this call this week. The good thing, though, with the market expecting that change and potentially rate cuts in the future, shouldn't be too much of a shock to the market. In fact, there is the possibility that Warsh comes out more dovish than expected and talks the rest of the Fed down from focusing really too much on inflation. That would be a positive for the market and should support stocks near term. Get your $150 discount and see how to use options to leverage your return, reduce risk, and create income with our Ultimate Options course. Get the Strategy Finder, the calculator, everything you need, all with a 14-day money-back guarantee. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.